Vanguard just launched the cheapest fund that lets you own the entire global stock market, and it is called the Vanguard FTSE Global All Cap UCITS ETF, ticker symbol VALL. At just 0.07% expense ratio, this ETF is cheaper than the crowd's favorite VWRA by half and cheaper than all the other names like ACWD and IMIT. It is also Ireland domiciled, so you still get the lower dividend withholding tax while staying out of US estate tax. So the question is this ETF really that good and should you switch over? In this video, I will show you what you really get for that lower fee, whether you should switch, and if you do, how can you find it on IBKR? Because there are a bunch of them with the same names, and you wouldn't want to buy the wrong one. Let's not waste any time and let's jump right in. First up, here are the basics. Depending on which exchange you are trading it on, the ticker will be different. For most people living in Singapore, since you are trading it on the London Stock Exchange and the currency that you probably want is the USD, the one that you will go for would be VALU. Though, for some reason on IBKR, it is listed as VALL, or what some people now refer to as one ETF to rule them all. As mentioned earlier, this ETF is domiciled in Ireland, so instead of having to pay 30% withholding tax, you only need to pay 15%. And it also helps you avoid the US estate tax, which could slap away up to 40% on anything above $60,000 if you are investing in US holdings. But wait, that's not all. At just 0.07% expense ratio, if you were to switch away from, say, VWRA, assuming 100k invested over 30 years at 7% return, you will save over $14,000. And that's actually quite a lot of money, because with that money, you could buy over 4,000 plates of chicken rice. But then, what exactly are you getting with that ETF? Unlike VWRA, which hosts 4,000 over companies, VALL hosts over 10,000, and those extra 5,862 companies are all small cap companies, meaning companies with a median market cap of just $540 million. So they are mostly small companies that you and I have never heard of. If you map it out, you can see that while VWRA has 80% of its holdings in large cap and 20% in mid caps, VALL has 73% in large cap, 18% in mid cap, while allocating an additional 8.8% to small caps. Meanwhile, everything else is almost the same. You get about the same allocation to the top 10 companies, almost the same country breakdown, and even almost the same sector split. Now, even though both VALL and VWRA hold global stocks, because VALL holds small caps while VWRA doesn't, they aren't the same kind of ETF at all. It's like comparing McChicken with McSpicy. Even though both are chicken, one will give you lao sai, while the other won't. Instead, VALL is a lot more similar to IMIT, aka the Spider MSCI ACWI IMI fund, which hosts global large, mid and small caps too, and have 8,000 over companies. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video, which then brings the question, is it actually worth owning an additional 5,000 small cap stocks, and how would it affect your performance? Over the last 10 years, the index which VALL tracks returned around 223%, including dividends, whereas VWRA returned 232%. That meant that while VWRA did outperform VALL, this outperformance is seabay tiny, and you can see it in the annualized returns, whether it is 1 year, 3 years, 5 years, or even 10 years, their percentage point difference are all 0.5 or lower. As you might have guessed, the reason VALL underperformed VWRA is because over that same period, global small caps didn't do as well as global large caps. That is because companies such as Apple, Google, Microsoft, and Amazon spent those years building the phones, the cloud, the ad networks, and now AI. Those are winner takes the most businesses, so a handful of names ended up with the most of the profit. Meanwhile, small caps are mostly domestic businesses serving their home markets, and they were never really in the race. But then, does this mean that small caps are sucky? Of course not. Check this out. This is a chart which compares the 10-year rolling returns spreads between small caps and large caps. Above that line means small caps are winning, and below means large caps are winning. The The first thing you will notice is that small caps and large caps have been taking turns outperforming each other, and there were indeed periods where small caps did outperform large caps, whether it is the 1940s, the 1960s, the late 1970s, into the mid-1980s, or the years after the dot-com crash, and it's only recently that large caps have started outperforming small caps. What this tells us is that even though VALL is currently underperforming VWRA, cycles do eventually turn. And when that happens, it could be VALL's turn to shine. This can happen to several reasons. For one, small cap companies tend to do better when interest rates come down. That's because small caps tend to use more debt and borrow at higher rates as compared to many large cap companies. So when interest rates eventually come down, the cost of borrowing will get cheaper for many of these companies. Not only that, small cap companies tend to be more sheltered from trade tensions and tariffs. That's because most of them sell at home, while the big global names sell into every market. At the same time, small cap stocks are currently trading at a lower valuation as compared to large caps. So when the cycle eventually turns, small caps would be starting from a cheaper base. So is it actually worth switching over from a global stock market fund like VWRA or IMET into VALL? Well, the obvious selling point of VALL is the extra holdings. With this, you will get diversification gao. But even with those 5,000 extra companies, the small cap slice is only 8.8% of VALL. So even if small caps do turn and start beating large caps, it will only make a very small impact on the ETF, as we have already seen from the historical returns. Instead, the main reason to switch over is really just the lower fee. The example I showed you earlier only assumes you invest 100k. But what if you are investing a larger amount, like 500k or even $1 million? Then the savings will scale up right along with it. But with that being said, even if you eventually do decide to switch over, it is best not to rush in right now. And that's because of the fund size. VALL currently holds about $7.3 million in global British pounds, or about $10 million US. In comparison, VWRA holds $53 billion US, which is like over 5,000 times bigger. And that is important because ETFs holding less than $50 million in assets have a much higher risk of getting shut down. Though, to be fair, I don't think that is the real risk here. That's because this is Vanguard that we are talking about, and given their popularity and how cheap this fund is, there's a good chance that this ETF is going to gather money quickly. Instead, the bigger downside right now is the spread between the bid and ask. When a fund is new and is barely traded, the gap between the buying price and the selling price is wider. So while you could be saving 0.07% a year in fees, you could also end up paying a little more on the spreads. That's why if you are going to buy it, I would probably give it a few more quarters for the volume to build up first. That way, you minimize the risk of the funds closing down while getting a tighter bid-ask spread as well. But whether you should sell all your global ETFs and move over, that's a different calculation altogether. On IBKR's tiered plan, each trade on the London Stock Exchange will cost you about 0.05% of trade value, with a minimum of $1.70 up to a maximum of $39. Though, third-party fees such as exchange fees and clearing fees would still continue to go up. In return for switching over, you get to save about 0.07% in expense ratios a year. So if you run the numbers, you can see that if you are switching anywhere between a few $1,000s up to 78k, your break-even will sit around 1.6 years. But then for anything larger, your break-even will drop pretty quickly to even as low as 2 months. Though, this is ignoring the bid-ask spread. If we were to include that, the break-even would go up a little. But even with that, by switching over, you could actually save quite a bit of money over the long term. Though, one thing to consider is the tax bill. While selling doesn't trigger a tax bill in Singapore, yay! If you are from another country like the UK, by switching over, you could trigger a tax event and end up handling a chunk of your gains to the taxman. Now, if you are going to buy this on IBKR, here's where you need to be careful. That's because when you search for VALL, you have 3 similar looking results. One of them is BVME, which is the Borsa Italiana exchange. So that isn't the one that we want. Instead, we want the one that's listed on the London Stock Exchange. But how do you know which is the correct one? To check, all you gotta do is tap into one of them. If the currency shows GBP, that is the wrong one. Instead, go for the one that is trading in US dollars. Once you have found it, you can just tap the heart icon at the bottom left to add it to your watch list. So you don't have to keep searching for it every time. So there you have it. That was a quick breakdown of VALL and how to get it. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.